Investing your money has its fair share of risks, but what if you know what to expect? You can make wise choices. Troy Sutton breaks it down in this week's KTAB Financial Friday.
I had an interesting experience this week that draws quite an analogy. You see, my daughter's dog, Ozzy, is a miniature golden doodle, full of puppy enthusiasm, loyalty, and furry cuteness. He is healthy. He's got all of his shots, including the one that keeps fleas and ticks and other teeny critters from vacationing in his skin. He's happy and lovable. And one night, earlier this week, after he apparently spent quite a bit of time outside, out even of the boundaries of our yard, he came to cuddle and sleep on my belly as I lay down for sleep myself. It's not a frequent occurrence, but occasionally, as the alpha male in my house, the only male in my house, I deign to cuddle with the puppy. I'm not sure how long he slept there before my daughter came and got him. I'd gone to bed early and even taken a Tylenol PM, which I rarely do. But 8 hours later, I woke up feeling itchy. A little here, a lot there, and the proverbial, what the heck are all of these red welts all over my body? I woke up, wouldn't you know it, with chigger bites. It's days later, and I still feel the burn and the itch of those bites that I've learned now can take up to 2 weeks to heal. Now, in hindsight, I knew that there was a risk of lie down with dogs and get up with chiggers. It was a small risk because we've given the dog shots, bathed them regularly, groomed them often, and never once in my life with multiple dogs has this ever occurred to me or anyone in my family. I chuckled that morning as I showered and counted nearly 100 different bite locations. I pictured an investment prospectus about sleeping with cuddly puppies. Quote, potential risks can cause intense itching and reddish welts on the skin. The intense irritation and subsequent scratching may result in secondary infection. In some parts of the world, chiggers transmit scrub typhus, and you could lose your sanity to all of the scratchy discomfort of these Satan-spawned critters. Welcome to the investment world. Everything we do in the investment world with money, even the simplest of all investments, can go wrong. Often they do not, but sometimes they do. So what are some of these risks? Some being the operative word because there are entirely too many to cover. That's why you get prospectuses that are this thick. First, let's talk about inflation risk. What is that? If you have a CD or a savings account or a guaranteed annuity or a pension plan that's sending you income, if it doesn't grow very much in this low interest rate environment, let's say inflation is at 3% per year and your CD earns an average maybe 1.5% per year, did you really make any money? No. Why? Because we use money to buy things. In that circumstance, your money now buys less than what it could the year before because prices of goods and services have gone up faster than the value of your CD, your pension income, your savings account, or your fixed annuity. That's a risk. Second, the risk of loss of either your earned returns or even the loss of your original investment. This is probably the first risk that popped into your mind, bing, because everyone has a family member or yourself that lost all of your retirement money in the 2008 stock market crash. Trading stocks or bonds or currencies, commodities, loans, real estate or more have circumstances where the values will bomb. Often they do just fine. But sometimes you can walk away with less than what you put in or nothing at all. Third, volatility risk. See, buyers and sellers are humans. What one human thinks is a good deal, another human thinks is a terrible deal. Prices on houses, cars, stocks, bonds, and even the value of your contributions at work as perceived by other people are not always the same. So prices going up and down, sometimes slowly, sometimes quickly, sometimes vastly different, is what we call volatility risk. And when you need money from your IRA invested in, say, mutual funds, maybe the value of those funds when you need to make a withdrawal are at a peak, or maybe they're in the trough. What if your parents, say bought a rental property at the height of the real estate bubble in California back in 2007, and then they died of heart attack in 2010 when home values plummeted 40%? Would you sell that rental house if you couldn't even pay off the mortgage? That's liquidity, or that's volatility and risk of loss. Fourth, liquidity risk, Liquidity, in essence, is how quickly you can turn an investment into cash to meet debt obligations or to prevent or minimize losses. Totally liquid money sitting in your checking account doesn't earn very much. Money invested in, say, an oil well, particularly if that oil well ain't producing, may take months or even years to sell and turn into cash. What about your investments? Some investments don't just cash out if the owner dies, and some investments do. You have to know what you have in order to prepare accordingly. And now those are just some of the risks, 4 of the risks. And each one can be mitigated through holding a variety of investments that maybe complement each other. That means some of your money is volatile, some of your money is not liquid or accessible, some of your money doesn't earn very much because it's available for you to withdraw, and some might even lose value. Nevertheless, when one investment is down, often, not always, but often other investments are up. So look at your portfolio as a whole, and just remember, even with the best of intentions from a quality and experienced advisor or money manager, when you choose to lay down with puppies, you still might get up with jiggers.
All right, thank you, Troy. If you would like to contact Sutton Financial Group, they are located at 2449 South Willis in Suite 106. You can call them at 437-0709 or go to suttonfinancialgroup.com.